Ladies and gentlemen, my name is Andrew Stotts, and I am the co creator of the Valuation Masterclass. And tonight we're going to have a presentation from one of our Valuation Masterclass bootcamp students. And I'm excited for this one. The company is Chevron, and the student's name is John Paul Huaban, and I call him JP. And I've known him for a while now, so we'll bring him on now and start to talk a little bit. But if you've got questions about Chevron and his valuation, make sure that you put those questions into the chat because I'll see them and I'll be able to ask him those. And feel free to ask him tough questions. He's prepared for that. JP, are you ready for some tough questions?
I'll try my best.
I think you'll do fine. I think you'll do fine. We should tell the audience how we first came to know each other, and now this is kind of the second time that we've got a chance to work together. But maybe you can tell just your story very briefly.
So I first joined the Valuation Masterclass when it was in its third batch, and now we're at batch 16. And the third batch really inspired me to take part in the CFA exam, and gladly I passed my first levels. And I believe that the Valuation Masterclass helped me in studying for the CFA exams as well because I was able to put a lot of theory into practice during the Valuation Masterclass.
Mm. Well, I think we're going to see some of that theory into practice right now. So let me bring up your presentation here. And so the company you're going to be talking about is Chevron. I'm really interested to hear what you have to say. What I'm going to do is I'm going to exit this and let you take over. So first, I'm going to take my video out and take myself. Now you can take it away. Go for it.
All right. Good day. I'm JP Waban presenting the equity valuation for Chevron, the company that is securing its place in the market in every way possible. I initiate coverage on Chevron with a buy recommendation based on a target price of $211 US. This implies an upside of 30%. I derive my target price from a free cash flow to the firm based valuation using a weighted average cost of capital of 11.9% and a terminal growth rate of 1%. Some highlights include that I believe Chevron will capitalize on the OPEC Plus voluntary production cuts by ramping its productions by two things. First one is developing the Permian Basin, and second is acquiring Hess. Some risks that when it comes to Chevron is the failure to acquire Hess, the failure to integrate Hess into its current operations, the exposure to crude oil prices, and the rate of technological advances in renewable energy. Now, without further ado, let's get into it. Chevron was founded in 1979. Its history spanning 2 centuries has put it in a unique position to accumulate proved reserves of over 11 billion barrels net oil equivalent and nearly 64 million acres of land leased for oil and gas exploration as of 2023. Today, Chevron is a global energy company with its earnings primarily driven by the upstream business segment, accounting for 74% of segment earnings in 2023. As of Q1 2024, an estimated 12% of total industry revenue is attributable to Chevron alone. Before we talk about Chevron's highlights, let's get to know the industry Chevron operates in, which is the integrated oil and gas industry. Since humanity discovered this dinosaur juice, they have turned it into black gold by driving progress forward, from warming homes to powering cars to dreaming of sending people to Mars. In fact, as of 2023, the market size is nearly 7 trillion US dollars, and this is expected to grow as high as 9 trillion by 2031. Companies in the integrated oil and gas industry pertain to those engaged in all three business segments: upstream, which extracts the oil and gas; midstream, which processes and transports it; and downstream, which delivers it to end users. It has several major players, including state-owned companies like Saudi Aramco and Sinopec, and MNCs like ExxonMobil, BP, Shell, and my group's beloved Chevron. The Organization of the Petroleum Exporting Countries Plus collectively produces at least 45 million barrels per day, which means OPEC Plus decisions on oil production quotas have great impact on global oil prices. Today, the energy landscape continues to be swayed by disruptors such as renewables, which is projected to reach 45% of global electricity generation by 2030, and energy storage costs, which have fallen by 89% since 2010. This further enhances the availability of renewables. However, as much as promising RE is, it is unrealistic for us to rush into it. For example, a lot of components of solar panels and windmills come from critical minerals. Simply rushing into RE would mean scaling up mining, which may still contribute negatively to the climate crisis. And that is ironic because shouldn't our end goal be sustainability? So the question of how to source metals and minerals remain a legitimate and urgent one. So what's the best solution for us here? Using what we currently have, which is liquefied natural gas, which is a bridge energy source before renewable energy can be relied on. So, with the rising popularity of renewable energy, many people say the days of the global oil and gas industry are nigh. But I believe that despite disruptors, oil and gas is anything but a sunset industry, as decarbonization efforts still open doors to opportunity. For many companies in the oil and gas industry, they stand to benefit from rising global gas demand and likely strong prices over the next decade as LNG becomes important to managing renewable intermittency. Now that we've discussed Chevron and the industry it operates in, let's talk about the stories that will drive Chevron's share price forward. As an analyst, I found Chevron ramping up production to capitalize on the future of oil and gas. My first story is about OPEC Plus, which had a meeting on the 2nd of June 2024, and they plan to extend their two voluntary cuts. The first one being the 1.65 million barrel voluntary cut, which initially announced in April 2023 will now be extended until December 2025. The second one being the 2.2 barrels per day voluntary cut initially announced in November 2023 will be extended until September 2024 and will be gradually phased out on a monthly basis. Now, what is the effect on Chevron? What this will do is it will help sustain crude oil prices, and therefore it's a great opportunity for Chevron to ramp up production. And in my investigation, I found them doing exactly just that, which brings me to my second story. In 2023, out of the 3.1 million barrels Chevron's upstream operation produces, nearly 800,000 daily barrels came from the Permian Basin. Chevron announced that it will be devoting $5 billion to develop the Permian in order to bring production up to 1 million daily barrels in 2025. Now, why is this important? Because of the 2.2 million net acreage owned by Chevron in the Permian, 75% have little to no royalty payments. Thus, this gives them a cost advantage compared to their peers. Another way Chevron is boosting production is through the acquisition of Hess, which produces nearly 400,000 daily barrels as of 2023. Now, Hess has a market cap of 41.6 billion US dollars, and by acquiring them, Chevron will gain access to firstly the Bakken Shale in North Dakota, which has 465,000 net acres of long-term resources, and second is the Guyana asset, where off the shores of Guyana, South America, is the Starbrook block, in which Hess has a 30% ownership in more than 11 billion barrels. Guyana assets are expected to produce over 1 million daily barrels by 2027. However, there are risks involved here, which I will discuss later. In the first quarter of 2024, Chevron experienced decreases in revenue by 4.6% year-on-year, gross profit down by 7.3% year-on-year, EBIT down by 17.8% year-on-year, net profit also decreased by 16.3% year-on-year, and EPS is lower by 14% year-on-year. This is Chevron's consensus recommendations, which rates at 2.2, and it is thus between a buy and a hold. This is because of the 25 analysts currently covering Chevron, 2 recommended a strong buy, 15 chose to buy, while 8 opted to hold. Consensus revenue forecast fluctuates between -2% and 2%, which reflects the volatile nature of oil and gas prices. A rather odd development we have here is the higher gross margins averaging 41% from 2024 to 2026. This could be due to the analysts incorporating into their financial models the cost efficiencies Chevron obtains from developing its share in the Permian Basin. Now, let's look at the revenue structure. Chevron operates in 2 business segments. For the upstream segment, revenues are derived from the production and sale of crude oil and natural gas, as well as the sale of third-party natural gas, while downstream segments are sourced from refining. Downstream segment revenues are sourced from the refining and marketing of petroleum products, such as gasoline and other products derived from crude oil. In 2023, revenues from upstream amounted only to 46 billion, while downstream revenues amounted to 151 billion, both of which are lower than their 2022 counterparts of 64 billion and 172 billion. This is attributable mostly due to lower crude oil prices in 2023. Now, before we look at my projections, let's look at where Chevron is now using proprietary tools from A-Stot's investment firms research. In the FVMR, we look at a Chevron's historical and past 12-month state, its fundamentals, valuations, momentum, and risk, compared to 1,830 non-financial companies in the USA. For fundamentals, Chevron had a great performance in 2022, but this was offset by its lackluster 2023 performance. For the valuation, it is slightly attractive compared to other companies as its price to sale and price to book are low, while EV to EBIT are high. For momentum, although in 2022 Chevron showed great promise, its momentum took a nosedive due to lower price realization from crude oil products, thus making it very unattractive. Compared to 1,830 companies for risk, Chevron presents lower risk because despite higher net debt to equity ratio in 2023, the number of times Chevron can pay back its interest remains high at 40.7, which lowers its risk. Now let's look at the world-class benchmarking where we compared Chevron to 320 large energy companies worldwide. Chevron ranks neutral in profitable growth as it has room for improvement in both profitability and growth. Chevron's profitability peaked at number 20 at 3 in 2022 but has since went down to number 5 in 2023. Chevron's growth peaked at number 2 in 2021 but has since gone down to number 8 in 2023. This is both due to lower revenue growth and expense direction. But however, when we look at the past 12 months, I can see improvements in profitability, growth, and expense direction. This is mainly due to higher crude oil prices and lower operating costs in the first quarter of 2024. Now, let's talk about my forecast. I believe that compared to 2023, the average crude oil price will be much higher in 2024 and 2025, hence the rising revenue. This is mainly due to the OPEC plus oil production cuts, which I mentioned earlier. I also expect revenue to take a slight dip in 2026 and recover in 2027 and 2028. Historical gross profit were about 30%. I forecasted mine to be higher at 32% due to the cost savings Chevron might achieve from developing the Permian Basin. I also expect SG&A to continually increase as the years go by. I expect current asset items like receivables and inventories to be in line with historical trends. I forecasted long-term investments to increase primarily due to income from Chevron's affiliates. I also forecasted fixed assets to increase in 2024, 2026 to 2028 by 16 billion, which is in line with their capex guidance. This 16 billion increase will be partly offset by depreciation. In 2025, I believe net fixed asset will increase by a significant amount as Chevron acquires Hess. Since the acquisition is still in progress, there is uncertainty as to the final amount of goodwill. Hence, I only increased it by a tiny amount to be conservative in my forecast. I expect accounts payable and other current liabilities to be in line with historical trends. However, I believe the acquisition as well as the Permian Basin development will have to be financed externally using long-term debt. That's why I project it to increase. Historically, Chevron is a dividend-paying machine. Hence, I expect dividends to offset the increase in debt. And now you're probably wondering why I have a 30% upside. One of the factors is that Chevron has historically a negative cash conversion cycle, which I expect to continue. This means Chevron gets the benefit of quickly turning its inventory to cash, which they can then use to fund their operations and expansion plans. Let's look at our relative valuation. On the forward 2025 PB multiple, Chevron looks cheaper compared to the energy sector in the USA only. I also forecast its return on equity to be around 14% in 2025, which is higher than the sector average in Asia, but still lower than the US sector average and globally. Thus, Chevron looks slightly expensive when using the PB to ROE ratio relative to the US, global, and Asia ex Japan peers. On the forward 2025 multiple, Chevron trades at a premium to the energy sector in the US, Asia ex Japan, and the world. I forecast its EPS to grow at 2% in 2025, which is much lower than the expected EPS for its sector in the US, Asia ex Japan, and globally. This highlights that Chevron is highly expensive relative to its peers when using the 2025 PEG ratio. Now let's dive into my valuation, where I assume a risk-free rate of 4% and a market equity risk premium for the US market of 10%. I also assume a beta of 1.0, and I forecast capital structure with about 15% debt to total capital. This results in a WACC of 11.9%, and I use free cash flow to the firm to value Chevron. In my base case scenario, I anticipate sales growth of 1.2% until 2028, leading to a value of 211 US dollars based on the FCFF methodology. This represents a 30% upside to the current market price. In my sensitivity analysis, the optimistic case assumes a sales growth of 1.3% until 2028, resulting in a target price of 212 US dollars. Conversely, in the pessimistic case, sales growth is assumed to be 1.1%, yielding a value of 210 per share. Now let's talk about the risk involved with Chevron. Chevron may not acquire Hess within the anticipated time frame or it may even fail to do so. As per Chevron's 2023 10K form, failure to satisfy all of the Federal Trade Commission's required conditions could delay completion of the acquisition for a significant period of time or prevent it from occurring at all. And the second risk is Chevron may not successfully integrate Guyana assets into its operations. Because even if Chevron acquires Hess, there is still a risk that Chevron may fail to integrate the Guyana assets. And why is this? Because Hess currently has a joint operation agreement with ExxonMobil and China National Offshore Oil Corporation, where it owns 30%, while the latter two owns 45% and 25% respectively of the Stabroek block in offshore Guyana. However, both ExxonMobil and SEAN and OOC are considering the right to preemption of sale. And in that case, even if the acquisition continues, they should both have the right to buy Hess share in the joint operation first. Now, as per Chevron's second quarter earnings call, the arbitration panel addressing the Stabroek joint operation agreement has set a hearing for next year to discuss the right of first preemption that goes to ExxonMobil and CNOOC. So this is still a pending case. Other risks include Chevron being exposed to the effects of changing crude oil prices and also the rate of technological advances in renewable energy. Although I believe that the risk is small, it has a great impact on Chevron if it does occur. So now I'm done with my presentation.
Excellent. All right. So we've got some questions that have come in. Let me just start bringing in some of those questions. Yash asks, if Chevron fails to integrate the Guyana assets, will your buy recommendation change?
If Chevron fails to integrate the Guyana asset, will my buy recommendation change? I say no to that because what I did for my forecast is I only integrated the Bakken Shale development of Hess and also the 400,000 um, daily barrels that Hess produces. I did not integrate the Guyana assets because there is still a chance that ExxonMobil or CNOOC may win the right to preemption. Although Chevron keeps saying in its earnings call that they are confident that the arbitration panel will side with them, this could still be, just them trying to get their investors to retain hope in their company. So even if they fail to acquire Guyana, my recommendations will still be a buy because it doesn't factor in the Guyana assets yet.
Okay, so you've been conservative there. That's good. You
Yes.
mentioned that LNG is one of the main drivers of oil and gas demand. Does Chevron have extensive exposure to LNG compared to its peers?
Based on my research, the one that has extensive exposure is companies like ExxonMobil, where they have LNG um, LNG terminals all over the world. But when we look at Chevron, it only has LNG um, facilities in Angola and Australia currently, but it did enter into a long-term purchase commitment with companies like Cheniere and Venture Global. So it does not directly have that much extensive exposure to LNG. And that's what I like about Chevron actually, because it knows how to prioritize its goals. So what they're prioritizing right now is developing the Permian and also trying to acquire Hess and develop those. And when it comes to LNG, maybe when those are done, they can concentrate on LNG more.
Okay, so Ibrahim says OPEC cut next year's demand growth estimate to 1.78 million uh, barrels per day from 1.85 million. Was this factored into your model? And if not, how would this affect your forecasts?
Yes, I factored this into my model actually.
Okay. So you're up to date on OPEC. All right. Last question coming in. If company's not sure of acquisition of Hess because it's main risk of your valuation, does the company have any other expansion or diversification plan?
Now, when it comes to the Hess acquisition, the both the shareholders of Chevron and the shareholders of Hess already approved it. Now it's just up to the Federal Trade Commission to review the documents for that. And they also have the Permian Basin to, and also they can always look for other companies to acquire if the Hess deal doesn't go through.
Okay. So how does it feel to graduate from the Valuation Masterclass Bootcamp again?
It feels awesome actually. Back then, I wasn't really sure because I didn't have any background in finance. And now that I took part in the CFA level one examination, passed it, now I have all these theories that I've been wanting to put into practice. And that's exactly what happened in um, this valuation masterclass. So thank you for the opportunity
Yeah.
to
In fact,
talk
we've
about it.
developed it so much, compared to when you came in boot camp number 3, now at
Yeah.
16. I think it's a much better, course now. And I look at the result of what you produced there and it was amazing.
Thank you so much.
Yeah. Um, I also like the order that you put things in. We may have to make some changes now that I saw your good
Yeah.
order that you did it with talking about the company's background, then the industry, and then the company. I've always kind of had the company headlines there because I wanted people to dig into the company, but I do see putting it in an industry context has some value. So you demonstrated that.
Yes, thank you so much for appreciating that.
Yep.
I did that because there were some terms that I discussed in the industry analysis which I had to, show first
Yep.
so that the people can understand better.
And how would you describe the transformation that you went through?
I'd say that I became more resilient with the valuation masterclass. Back then, I would easily cave into pressure and just quickly give up. Like when I was working as an auditor, I'd let the pressure get to me. But right now, even if the pressure is still there, I still push through. And I guess that's like my message to anyone that's experiencing anxiety, depression, bipolar, or even borderline personality disorder. Like if you have mental health disorders, that's not you can still push through and find the strength to achieve your goals, and that's exactly what I hope I did today.
Yeah, well, I was so messed up when I was a kid that they put me on Ritalin when I was like 7 or 8.
Yeah.
And so the point is too, we can change and we can grow and we can improve ourselves, but we can also take advantage of some of the what some societies may call weaknesses, and we can turn them into strengths. And so I think that's one thing that you've done really well. So I just want to congratulate you. I'm going to take you off the screen now, and then we'll have more discussions later. But well done.
All right, thank you so much.
Yep. Well, that was incredible. A great presentation. And for those people that aren't following it, he changed around the order of some things in the presentation from what we normally do. And I really liked the flow that he did. We may use that for boot camp number 17. If you want to build a competitive advantage in company valuation, why not join us here at the Valuation Masterclass boot camp? We start the next one in less than 30 days. and we've got a spot for you. So just go to valuationmasterclass.com/bootcamp, and hopefully we'll see you in there.